Hello, everyone, and welcome to our December investment market update. Today, I'm delighted to be joined again by Janet Mui, who is Head of Market Analysis for RBC Brewin Dolphin. Morning, Janet. How are you?
Hi, Michael. I'm very well. Thanks for having me.
Good. Thanks for coming back on again. We've obviously already got some slides up, so we might as well move straight on into it. Janet, if you're happy to push forward with your presentation, that'd be great, and we'll go from there.
Yes, absolutely. So, well, we're in December already, so we're looking forward to 2024. And so my update will primarily be focused on the outlook for next year. So I think I have some good news for everybody. We do think that there is still risk with the economic outlook, but so far the data-wise has been moving in a soft landing kind of direction. So as a reminder, what is a soft landing? It means that growth is slowing. So that's pretty much a consensus. And inflation is slowing. But growth is not slowing to the extent that we are going to see a recession. So the chance of that happening has actually risen because of the direction of the data. So we'll talk about that more in a bit detail. So basically, we think that inflation, first of all, heading in the right direction. Developed market economies all slowing down actually very meaningfully in the course of this year. And we expect that to continue for a number of factors. So we'll discuss that in a bit. But of course, you can never say never. There is always a risk out there. And one of the tail risks would be energy prices. As always, that's always have the possibility to change the near-term inflation outlook. So we'll have to watch out for that. But so far, we think the core theme is that inflation would be steadily heading towards that 2% eventually. So in terms of growth, right? So this is a very, very tricky part because at the beginning of the year, I think a lot of economists and strategists were really thinking that the risk of a recession is quite high, which is a fair enough assessment given that we have one of the most aggressive rate increase cycle, and that really historically tends to lead to a hard landing, right? But of course, every cycle is different. This time around, there are a number of factors that affect how the activity plays out. For example, this time around, consumer does still have excess saving from the pandemic. And of course, the government has tried to shield the most vulnerable from the high energy cost, et cetera, et cetera. So we do feel that in terms of the recent economic data, particularly from the US, the chance of a soft landing has risen. So that's great news. So we'll talk a bit more about that on the other major economies as well. But of course, we can't dismiss completely that recession risk, right? Given that we've seen interest rate rising from 0 to over 5%, right? So sometimes it takes a bit longer for the impact to play out. I think that will be more visible in the UK, for example, given how long the mortgages are being fixed. But we'll discuss that a bit. So we have to understand the macro risk remain higher than any given year. So what does it mean for monetary policy? That's really the most important thing that matters for financial markets. We have already seen how powerful that is actually when markets think the Fed will pivot, for example, to rate cuts next year. So our belief is that we have seen the last of the rate hikes already. So the market is not even talking about rate hikes anymore, the possibility of that. Of course, never say never again, but there's a very high chance that we are likely to see rate maintain at the current level for a bit, and then we will see rate cuts sometime next year. It's very difficult to debate when the cuts will start. We can talk a bit about market expectation. It depends on inflation, but there's a very high chance that we will see rate cuts next year, which historically is very powerful for financial markets, whether you're talking about bonds or equities. So I think overall, the macro picture, there's always a bit of uncertainty, but it seems that we have a bit less uncertainty than at the start of this year, when people are very worried about a recession and inflation was still very much sky high, right? So this slide is just basically showing you the difficulty of how economists can assess whether we're going to have a hard landing or a soft landing. So you always have to look at the various drivers, and you think whether each scenario has a higher chance of that happening. So we we previously thought is about half the chance, but I think we now have a bit more confidence that we are moving towards a glass half full kind of scenario, which is, as I mentioned, soft landing, inflation slows to or towards 2%, and we'll see rate cuts. And that is a very different scenario from a recession, stickily high inflation, and if interest rates were to stay high. So that glass half empty scenario would be not a good scenario for financial markets. So you can see the odds of the positive scenario is playing out as we head into 2024, we think. So inflation direction, so this will directly dictate the policy outlook, right? So we have to say central bankers, they don't actually know what they're going to do. It all depends on the inflation data, right? So you have to kind of monitor the leading indicators of inflation, monitor consumer expectation of inflation, for example, and they all tell us that they are heading toward 2%. There's several reasons. First of all, you can look at, say, the producer prices, where at the cost level, whether things are still very costly or is less costly. And you can look at a range of indicators that tells us producers are actually facing lower input costs compared to, say, 1 or 2 years ago. And imported prices, for example, in the UK, also coming down. If you look at, say, countries like China, they're seeing deflation, which means that their prices are actually falling on a year-on-year basis. So things that got exported to China is actually influencing things like the durable goods being consumed in the US. You can see that from the data. The durable goods, such as your cars, the white goods, for example, the prices are actually going down year-on-year. And of course, the monetary environment is still very tight, right? We're talking about borrowing cost at about 5%, officially. So that's a much tighter environment compared to previously. So there are these factors that are going to influence inflation going forward. So as a result, the consensus expectation for inflation for developed markets is generally towards 2%, as you can see from this chart. And you can see how meaningful inflation has fallen this year so far. So the thing is, the last mile of going from, say, about 3 to 4% to 2% would be a bit bumpy or a bit difficult to forecast exactly. But I think in general, we're at a much more comfortable place from, say, the start of the year. And you can understand why central bankers and, for example, us or the consensus are now more comfortable with the inflation outlook. And talking about growth, right? I think that is something that is very interesting to highlight, because we did see synchronization in terms of the interest rate hikes across, say, the US, the Euro area, and the UK, and other major developed economies like Canada, Australia, New Zealand, Canada. Like, everyone is actually raising interest rate. That's the theme for 2023. So growth, actually, there's some divergence, and the US remains the outperformer, and that really, really matters. So ultimately, if the US economy stays resilient, if it doesn't go into recession, I think that is what the market cares about the most. It's not like the UK or the Euro area, it doesn't matter. But I think as long as the US stays okay and achieves a soft landing, I think the markets would be happy. So I think the risk is that countries like the UK, we're still on a kind of struggling path, I would say. Because if you look at this chart, which shows the consensus 2024 GDP growth forecast, you can see that the UK, according to most economists, is expected to grow the slowest amongst the key economies. So expected to grow at about 0.4% next year, which is not bad, by the way. It's slow, it's kind of stagnating, but it's at least not negative, right? But the Bank of England actually is forecast is more gloomy. It's expecting 0% growth. So we are kind of hovering around the 0% line. Sometimes it may go under. So I think the recession risk and the concerns on the UK is not going to go away, particularly because of, well, many households we know still have to remortgage into high rates into 2024. So the pain is not completely realized yet. So I think there's always, so for those in the UK, the economic growth outlook is still a bit of a concern. But the fact is, if you invest, if you look at the global market, if your portfolio is more global or diversified, the US actually matters more in terms of how the global asset moves. So you can see that actually economists were initially expecting growth to slow in the US, but since the fourth quarter this year, they have been actually revising up the growth forecast, which you can see in the orange line. And you can see economists are now expecting US to grow at 1.2%. That is, again, nothing particularly too exciting, but it shows that the US is likely to achieve a soft landing. And the US, most importantly, is expected to outperform other major economies. So that has a number of implications in terms of asset classes. First of all, the dollar may actually continue to have a bit of strength over the other currencies from an economic outperformance perspective, even though some of that it could be driven by differences in interest rate. But the US is still going to be resilient, and capital is still likely to head to the US, for example. The stock market is likely to outperform from a growth perspective. The stock market in the US is very much domestically driven and oriented, as in the GDP is very sensitive to domestic growth. So there are a number of implications. And I think for global markets, as long as the US doesn't fall into recession, I think the current rally is likely to be sustainable. So we keep talking about the US, and the US labor market is the key to monitor whether we are seeing a soft landing or recession. So the reason why we have more confidence is on the soft landing is because things are actually slowing down, and it's intended. So remember, the reason why there is a rate increase is because the Federal Reserve wants to slow the economy. So you do want to see economic data slowing down. You don't want them to keep being so hot, right? But you also don't want them to be too bad. So it is actually a very tricky balance. But so far this year, it seems that actually that scenario is playing out. For example, on the left-hand side chart, it shows the job openings per unemployed person. And that basically shows you how tight the labor market is. If you have more jobs for each unemployed person, obviously is good for the job seekers. And it shows you that wage growth pressure is high because then employers have to put up the wages to attract people because there's so many job openings. So you can see we were at a high of 2 at some point in 2022, and now we are moving to about 1.4. Obviously, that's still tight, but it is heading into the right direction and moving more towards that pre-pandemic level.
Janet, just on that, just on unemployment levels, what is sort of the sweet spot for a growing economy? Is there a bit like we were talking about the metric with inflation being 2%, is what they're aiming for? Is there a metric on unemployment, job openings per unemployed person that is sort of seen as a sweet spot?
Yeah, I think historically, I think the US is hovering from about 1 to 1.2 if the economy is growing ever slightly. Because you have to understand that for the job openings and the unemployed, you do hope the ratio would be a bit higher than 1, because obviously the labor market is not completely efficient. So in the ideal scenario, it would be best to have 1 to 1. So 1 job opening per unemployed, so it can be matched, but we're not in an ideal world. So there's always friction. So ideally, there will be more job openings per unemployed, but we saw that at one point it rose to 2, which is obviously too many jobs, and so people can't find the right worker. So I would say the sweet spot would be between 1 to 1.
It's very interesting when you look at that graph. When you look at that graph, it sort of almost follows a similar trajectory to what the markets have done off the back of COVID with the dip, and then obviously really rallying off the back of that. And then obviously we're not seeing as much of a dip recently, but if it's going to get down a bit closer to that sweet spot, then I guess that's also a positive step, isn't it, then, to show that the economy is starting to get itself back on its feet within the US?
Yeah, the positive thing would be not an overheating economy. I think that's what the Federal Reserve wants to achieve. So I think if it gets back closer to the pre-pandemic level, that means more normalization, which is great. And it is actually very difficult to achieve when you raise interest rate from 0 to 5.5, for example, because sometimes you just cannot control it. That job openings may fall very sharply. It may plunge at some point. Who knows, right? So it's a very fine balance to achieve, but so far it is heading in the right direction. And unemployment rate, we saw that it's still hovering at a very low level, but I think this is something to monitor because historically, whenever the unemployment rate rises by over 0.5%, then it may trigger a recession. So far, we haven't really seen that yet, but it's something to monitor. Again, that is showing us that the economy is kind of moving along in a kind of nice and resilient direction. So nothing too drastic is actually happening in the labor market. We have to understand it's actually very rare, given that we have such a huge tightening in financial conditions. I think the reason why this cycle is so different is because the pandemic impact, the pandemic itself is a shock. So we are indeed quite different from how an economy would normally normalize and function. So I think this is why we're not seeing a recession, which many economists thought we would have seen one already by now. So yeah, so far so good, the labor market. And job creation is still okay. So the optimal number usually is about 150 to 200,000. We're still around that. It's pretty amazing, actually. We're still seeing such decent job gains, right? So far, that's why it's providing a lot of comfort to financial markets that things are heading in the right direction. And the very key thing is basically where interest rates are heading. And I mentioned how different economies actually, their growth expectation is different. Remember, I said the US is likely to grow the strongest, and the UK is still kind of struggling. But the key theme for next year is that most major central banks are expected to cut interest rate. Of course, you can argue about the timing. Every central bank may proceed at different times. But I think once a central bank moves, the other central bank typically follows. That's what happens pretty much historically. And you can see here is the expectation of financial markets of where interest rates are going to be. You can see basically interest rates are expected to be cut throughout next year. Starting the earliest is expected to be the Federal Reserve. They are expected to start in March next year, which is actually pretty soon, considering, well, a few weeks later it will be January 2024. So we can argue whether that's a bit overly optimistic, but generally, even the Federal Reserve itself projected it will cut by 3 times next year. So markets are expecting 5 to 6 rate cuts for next year. Again, whoever is right, we don't know because it depends on inflation. If inflation falls to 2, there's little reason why the Federal Reserve can't cut interest rate, especially if they're keen to avert a recession happening. So for European Central Bank, they're also expected to cut relatively quickly because inflation there is already two-handled. I think 2.9, the latest reading. So they actually have room to cut, and the economy is also a bit stagnating. I think Germany, its biggest economy, its economic data is not great, right? So they actually have more reasons to cut for next year. And the UK, I think the governor is trying to talk a bit tough. They are trying to push back against rate cut expectation because the UK's inflation is still pretty elevated at 4.6. So obviously the highest amounts the developed economies. But I think if the economy slows, they will have no other way but to cut interest rates. So UK expected a couple of cuts, 3 to 4 at least, is being priced in by financial markets.
But the general view is probably that's the latter part of next year, is it, Janet?
Later, I think for the UK,
yep,
is likely to move the latest. So the Fed is expected to move first, and then followed by European Central Bank, and then followed by the Bank of England. So our expectation is the bank will more likely move in the second half than the first half, primarily because of the still elevated inflation and wage growth. Yeah, but
we've obviously
seen.
Sorry, go on.
No, the key story is rate cutting for major central banks,
which is what's going to drive, hopefully, positive returns next year.
Yeah, yes, we already have seen how powerful that is in financial markets, which we'll talk about with some charts later. But you're absolutely right. It will be a very key theme that could drive both bond and equity prices up. So remember, in 2022, we had a very awful year when both bonds and equity prices fall, and that is exactly because everybody is raising interest rate. So when you have that in reverse, then it will be a reversal of that, which means we are likely going to see a pretty positive scenario for financial markets, right? So for mortgage holders in the UK, I think there is some good news because although the bank rate is still being held at 5.25%, the forward-looking market rates have already moved down, and the fixed mortgage rates are actually priced from the swap rates, which are market interest rates. As you can see, the 2-year and the 5-year swap rates have moved down significantly. So you would have seen those fixed mortgage rates being lowered already. And if this trend continues, then there will be further relief for mortgage holders. And that actually reduces the chance of a potential recession in the UK. Because if you're a mortgage holder, you thought you're going to remortgage at, say, over 5%. And maybe sometime next year when you do remortgage, it's going to be 4 something. So it is going to be some relief. So overall speaking, as I said, we do think the chance of a positive scenario has increased. But equally, the chance of something bad happening is not going to go away. There's always this risk. And I think the macro risk remains higher at least than any given year, right? So overall, we think that we think that bonds are likely to perform well in this market, whether you're talking about soft landing or recession. Because you think about it, for a soft landing, which means lower inflation, lower growth, still likely central banks cut interest rate because we're seeing lower inflation. So interest rates fall in that scenario. If we have a recession, then central banks actually need to catch up with cutting interest rates even more. So both scenario, interest rates fall. And in that scenario, bond prices goes up, right? So as you can see, this chart is basically showing a longer term view of UK interest rates. So what I showed you before was basically just 2024's view. This one is a bit longer term, what markets are pricing in up to 2029. So you can see that interest rates are expected to keep moving down over the course of next year and 2025 and 2026, right? So we're going to settle somewhere at about 3.5%. So that's almost 2% lower than current levels. But we have to understand that the longer term forecast it is, the more uncertain it is. So these pricing in information, it can change quite dramatically. But overall speaking, the trend is that interest rates is very unlikely to stay at current level for long. It's going to keep moving down over the next 2 years. And the asset class that would benefit in that environment would include bond. So that would have quite a high conviction in our view. But as Michael, you mentioned, equities tend to do well in an environment when interest rates fall as well, because borrowing costs are lower, people have more disposable income, businesses have have a less burdensome financial situation. So it tends to be quite a good phase in terms of the business cycle, the investment cycle, and also the financial markets. So I want to show you this chart, which is how global markets have performed so far this year. You can see that basically the US is a huge outperformer this year for various reasons. I think particularly because of the exposure to artificial intelligence, which we'll talk about it a bit later. But generally, you can see that asset markets, there has been quite a lot of volatility throughout this year. And the reason why is because no one is very sure about the interest rate outlook. If you remember this year, I know sometimes it's difficult to remember what things happened this year, but there were varying expectations of how many cuts are going to be, how is the peak like for interest rate. So the market fluctuates according to these expectations. But you can see very distinctly in the fourth quarter of this year, there has been a strong rally since November because we finally saw a couple of pauses in interest rate hikes, and there's more certainty, and the tone from central bankers just tells you they're done with interest rate hikes. So that is very powerful. You see that basically is a rally of everything since November onwards, and it has continued because the expectations are firming up that we're going to see rate cuts. We have not even seen the rate cuts yet. So I think if there's a realization of rate cuts next year, and if the economy achieves a soft landing, we do think the rally is sustainable.
Janet, I mean, what we've been talking about really over the last 12 months is that the markets haven't been really dramatically shifting either way, not up nor down. And I've sort of coined the phrase that we've been bobbing along, really, just waiting for some positive news to come back. So my sense is that December's rally that we've seen is off the back of obviously figures looking far more positive, and with now the forward view that rates will come down in 2024, everyone's been hanging on, just waiting for that whiff of optimism to come down the tracks, and it feels like perhaps that's arrived, and that's why we've seen the December rally.
I think that's some part to play because actually a lot of institutions, a lot of investment management houses, for example, there have been either neutral or a bit underweight equities. It is very difficult to be very, very bullish on equities this year when you know that there's recession risk going forward, you know that the Fed is still hiking interest rates. So I think positioning wise, a lot of people, as you said, are waiting for that positive catalyst because it's just so hard to predict. And once you get more confirmation, I think people are just more comfortable to put capital to work. Because historically, you know that when it's the last of the interest rate hike, and if there's interest rate cut, most likely bond prices rise, bond yields fall, and equity prices go up in the next 12 to 24 months, for example. And I think this is the catalyst that people have been looking for, is the Fed pivot. So I think you're right. I think including us, actually, we didn't have too much conviction on whether we can avoid a recession or not, but we do get finally a higher conviction with the Fed's expectation of rate cuts and also the data playing out so far. So we also have moved a bit more positive in terms of the market outlook. So we previously have been favoring more bonds, and we are a bit neutral on equities and even for US equities, but now we are more comfortable with being overweight in the US. So it's about the US economic outperformance, it's about the rate cuts, it's about also the AI boom. So we think that the main upside risk to equity market is the AI boom. So I think, again, it's just like the equity, it's just like the economy, right? So when AI comes to the scene, ChatGPT early this year, there's a lot of enthusiasm, and the market rallied because of these Magnificent Seven, which are the companies on the right-hand side, the logos on the right-hand side chart. Of course, NVIDIA is a huge outperformer, Microsoft as well, being geared to the AI theme. So there was a lot of enthusiasm, but it wasn't sure whether they can actually deliver. But so far, if you look at the earnings result of these companies, they actually have managed to beat expectations. And they actually can deliver the orders. They're seeing lots of demand. Actually, the supply is not enough to satisfy the demand of the chips, for example. So it does give us more confidence that actually the theme is likely to play out positively in the medium to longer term. And most importantly, it is justified by the earnings growth and delivery story. So it's not really just, of course, the valuations is high, but overall speaking, they are also delivering their earnings. So, and that is very important. So we think that the rally is actually justified. And we also think that it is a main upside risk to equity markets. And the market that is most exposed is, of course, the US. You can see it is such a huge driver for the US market this year. So I think for next year, the story could be a bit of broadening out of the market rally. So you can see from this chart, the S&P 500 equal weighted index has barely rallied actually, right? The gray line. If next year the economic environment remains okay, if there's rate cuts, then the rally could broaden out to beyond these Magnificent Seven. But Magnificent Seven could also do well, of course, in a more favorable economic environment. So that's why we think that the US market has the most upside risk, and we are more comfortable overweighting in the US market. And this chart is just basically reiterating why it is important to have equities in your portfolio. So I mentioned that actually the highest conviction we have would be bonds, simply because every single time the Fed pause and cut, bond yields go down every single time in the history. So that's why you can have more conviction that bonds will have a positive return. Equities, there's a high conviction, but as we know, equities, it can be volatile. And if there's a shock, there's an unknown, that can really topple things. So never say never. But in general, we feel more comfortable about the equity outlook. And it's a reminder that over the very long term, equities outperform cash by a long mile, right? I think it's a really good time to finally put your cash into work for next year. So this chart shows cash real returns, inflation adjusted cash versus FTSE All Share and MSCI World. And as you can see, first of all, equities outperform by a huge mile. Secondly, why it's important to have an international exposed diversified portfolio, because the MSCI World, which is mostly US geared, has outperformed and is likely to outperform still in the long run. So overall speaking, a summary of economic and market outlook. First of all, key theme is that interest rates have peaked and likely to see rate cuts. That's very powerful. And the odds of a soft landing has risen. But we have to remind ourselves there's still risk in the background. So we cannot completely be dismissing the recession risk yet. So investment view, that's why in terms of the macro views, the investment outlook is that the highest conviction will still be bonds and gilts in particular, because of the potential weakness in the UK economy. We have already actually seen that play out. We have seen that gilt yields have fallen very substantially in the course of the last 2 months. So I think it has played out this theme, but it could still play out even more in 2024 as rates are actually cut. So we upgraded equities to neutral, particularly overweight the US because of the AI exposure that we feel that is going to play out more. And also it's actually, US market is actually a defensive nature. What does it mean? It means that actually if there is say an economic slowdown or globally, or there are some shocks, actually the US is still regarded as a relative safe haven for capital markets. We actually saw that play out this year, right? So this year there is a lot of uncertainty on market, on interest rate outlook, and on growth. But because the biggest companies, they have such huge balance sheet, they have such huge cash flows, is actually regarded by investors as a safe haven. So we feel that we are comfortable with overweighting the US. You really do want to have more US equities in your portfolio in general, but of course, quality ones. So yeah, so I would say overall, yeah, 2024 is going to be hopefully more positive than this year. Yeah, it should be hopefully for the better.
Well, that's great, Janet. Always good to end the year on a positive note. It's obviously been quite a tumultuous year, couple of years, in fact, really. So thank you very much for ending the year with a positive note, and fingers crossed 2024 does play out as we all hope it does. Thanks ever so much.
Thank you.